Okay, hello traders and welcome to Trader's Talk. The purpose of Trader's Talk is to give you the truth of trading by interviewing top traders and investors alike who trade for real and give you different ways to trade the markets for consistent performance. Today on Trader's Talk, we have Stephen Clapham. Stephen Clapham is the founder of Behind the Balance Sheet, a London-based investment research and training consultancy, which produces bespoke research and runs training courses for a select group of institutional clients. Stephen Clapham spent some 20 years as an equity analyst at different investment banks, covering various sectors, and was consistently rated in the top 10 in his sector in Extel, and Reuters surveys. He moved to the buy side in 2005 and was a partner and head of research at two multi-billion-dollar hedge funds. He specialized in using a deep dive research approach to identify special situation opportunities. Stephen, it's such a great pleasure to have you on Trader's Talk today. How are you?
I'm very well. Well, thanks for having me. It's a lovely day, and I'm looking forward to our discussion.
All right, great. So let's get in just a little bit before we get into the nitty-gritty. I must say very quickly that I really thoroughly enjoyed reading your book, very well in-depth, researched and written. So before I ask you more detailed questions on the book and everything, and I was really looking forward to the interview today. But before that, maybe just for the viewers listening in and the attendees, just a little bit about yourself. So tell us, Stephen, like, how did you get into this world of investment? How old were you when you started? You know, what event triggered your interest, or do you do other things as well along with investment?
Well, I mean, I do other things. I mean, I got into it because I trained as an accountant, I became a management consultant, and I was working overseas. And I was brought back to London. I say brought back to London. I moved to London. I hadn't lived here before. I was asked by my then boss, who was based in London, if I would come here to do a project with them. And the project was it's a very complicated thing. I won't try and explain it, but it basically involved a lot of travel. So I said, yeah, sure, I'll come back to London. And came to London, and the project took forever to get off the ground. And I spent my time getting more and more expert in a very narrow field. And I didn't want to do this for the rest of my life. And I decided that I'd rather do something different. So I went and I got a job working for the fifth largest company in the UK. I'm not going to tell you the name of the company because I had a very, very senior role there. And I was interviewed by the finance director, the CFO. And I agreed the job, agreed the salary, the benefits, everything else. And then they sent me the contract, I sent it back, and I then got a phone call from the number two to the finance director saying, terribly sorry, we've made a mistake. And I said, well, what do you mean? He said, oh, you're too young for this grade. And I said, well, don't be ridiculous. I either do the job or not. And he said, well, yeah, you absolutely do the job and you will automatically get promoted next year, but you're just too young. And I said, well, sorry, I don't want to work for a company that has that mentality. And I just told him to stick his job. And I was telling a friend about this, and he said, why don't you go into the city? And I said, well, don't be daft. I don't know anybody in the city. I don't have any connections. And, how would I possibly do that? And he said, well, I don't know, but one of my friends works in the city, and he's head of research at a big stockbroking firm. And why not give him a call and see if he'll see you and tell you, what sort of job you could do and how you go about getting it. Well, I went to see the guy and he offered me a job on the spot. He looked at my CV and he said, oh, you'll be brilliant at this. Come and join us. It was actually my friend's secretary's husband. So I don't know whether, but anyway, it doesn't matter. I got the interview, I got the job, and I then became a research analyst at a sell-side firm. And I did that for a number of years before eventually moving to join one of my clients who ran a very large hedge fund. And it was actually the largest financials hedge fund in the world. And he brought me in to do all the non-financials research. That's when I became a special situations analyst.
Oh, wow. Okay. Interesting, right? One event leads to another, and you don't know actually how it's going to plan out when you look in the front. But only when you look back, the dots connect together, as Steve Jobs says, right?
Well, I think, lots of lots of people, who have had very successful careers, they didn't set out with that objective.
Exactly.
I know, you always read about these people who have been investing their pocket money since they're age 12.
Mhm.
But, I don't know any 12-year-olds that would be interested in investing. My children are slightly curious, but they're just like curious. Well, what does dad do? And he's a weirdo, sort of thing. They get no interest in it at all. And I think, some people obviously are very enthusiastic about investing and tend to end up in it. But in my case, it was a complete accident. I didn't know anything. I mean, I didn't know what a PE was. I had to learn it all.
Okay, interesting. Okay. Just tell us a little bit about, your main style of investment, Stephen. Are you like a value investor, growth investor? What would you categorize yourself as?
Well, I've never really understood these terms, value and growth. I mean, I understand what they are, but I think the growth investors who criticize value investors. I mean, you can't be an investor without being a value investor. Right? If you're going to invest in something, just by the idea of it, you're investing in it because you think you're being offered it at a price less than it's worth, or less than it will be worth. And so I always look at it. Warren Buffett said value and growth are two sides of the same coin. And I'm pretty pragmatic. And one of the hedge funds, somebody said, "Oh, we're always being criticized for being value investors." And we looked at the average multiple on the portfolio, and the multiple was over 20 times. And that was a time when valuations were lower than they are today, and that it was like a really punchy multiple. And we didn't set out with a view of, oh, let's go and find a growth stock. We didn't set out, oh, let's go and find a value stock. We set out with the idea, let's find a portfolio of stocks that offer us good value, potentially high upside, with not a huge amount of downside. And so that's I'm a special situations type of investor. I look for situations where there's an asymmetric risk reward. And, I'm prepared to take quite high risk situations where I believe that there's not a huge amount of downside and a lot of upside. And, often these are things where they might be perceived as value stocks because they're trading at, a massive discount, something that's fallen out of bed and people just, they can't bear to touch it. That's, those sorts of situations are often very interesting to me. But, that can be a growth stock that suddenly had a reversal in growth, for a temporary reason. I'm quite agnostic. I'm not one of these people that, as I observed on Twitter, I said to this guy, I said, I think you'd benefit from doing my valuation course. And he said, oh, I wouldn't find any interest in that. He said, I don't look at valuations. I just buy good companies. And I thought, well, that's a bizarre, to me, that's a bizarre way of investing, because you can buy good companies, but you don't know that you're going to make any money.
Exactly, spot on. Just a little bit to touch on, we'll go to this in more detail. You did mention about asymmetric reward risk. In fact, it's a principle that most investors talk about. If I would ask you, what is the minimum asymmetric reward risk you'll be looking for? Is it about 5 or is it 10 to 1? Because I was just speaking to Richard Hargreaves, an angel investor, and he was giving me some stats on his investments that he does in companies, and his was about 5 to 1. What would you say yours would be?
Well, that's a very unusual way of looking at it, particularly if you're doing unquoted.
Exactly. Yes.
If you're doing unquoted investments, particularly early stage investing, which I do a bit of, what you generally find is that a large number of them go bust. And the few that make you very high returns. So I would have said that if you were doing early stage venture capital, you'd want to have some. You can always lose 100%, and you will lose 100% in a reasonable frequency. So you need to be able to make at least 5 times. I would have said 10 times on upside, and with the potential maybe doing 100 times. But in the quoted markets, it's a slightly different equation, because you might say, oh, 5 times, because I think there's only 10% downside and there's 50% upside.
Mm-hmm.
That's not really a measure of the real risk distribution, because what you've also got to look at is what's the probability of each. So I don't tend to look at it like that. You can always lose 100% of your money.
Mm-hmm.
And funny enough, I've just been doing something for a client this morning where one of my training clients, my main business today is training institutional investors, and I've got an online school for private investors. But I also do some consulting work for the institutions, and I do some particular research. And I was just looking at how they should look at their the measurement of their portfolio in terms of what's the upside versus downside. And it's always a matter of looking at things where you think there's a high probability that your central case will happen. And if your central case doesn't happen, you've got some protections on the way down. So I won't do things like companies which are heavily leveraged, where there's a chance they may make it and you might make 10 times your money, but it's more probable they won't make it. Because I just think, 9 times out of 10, when you do that sort of thing, you'll lose all your money. And I don't like situations where there's a reasonable chance of losing all my money. What I prefer are things where, I think there's some asset backing, or I think that there's, a good business in there where even if it's has a setback, the setback won't endure for an extended period. And I don't have there's going to be 5 times as much upside as downside. The way I tend to look at it, I tend to say, okay, so I'm going to be in this situation for 18, 24, 36 months. And what I'm expecting is I'm buying it £1, and I'm expecting in 2 years' time, it'll be 150, 180. And if my central case doesn't work, then my downside might be 80p or something like that. And it's those sorts of situations that I'm looking for.
Okay, great. Yeah. Just a quick one that you mentioned about quoted and unquoted. Mainly, Stephen, are you mainly an investor in the quoted or unquoted market?
Well, I'm, the bulk of my portfolio is in quoted stocks, but I've got significant portfolio, probably 15 to 20 private investments. So, there's some amazing money to be made in venture capital today.
Correct.
And, I've been doing it for several years now. And, I've done, there's all sorts of good tax reasons for doing the unquoted stuff, because the EIS and SEIS framework gives you a very favorable tax break.
Exactly.
So, to me, that's a very good incentive. And I've had some very, very successful investments in that area. But it's very different from, my day job. And I've learned that, the skill set is quite different. And I therefore apply a different formula and different rules when I make those investments.
Interesting. Okay. Yeah. So because, the next person we're going to interview is mainly on the unquoted market, but it was good to hear from your side, which is going to go more in detail on. Coming back to this, Stephen, so on the quoted market, you say that the bulk of your portfolio is in that. So just maybe if you want to elaborate a bit more further, I know in your book, you've gone into so much depth, so much systematic, so much methodological in terms of looking at so many things in terms of the company financials, valuation, mode checklist. Chapter 9 and Chapter 11, I really enjoyed reading, which I will ask you a bit more further later on. But if you were to just put it like maybe, I know it's difficult to put it in a nutshell, but as much as you can, what would you say like your typical entry will look like for your investments? And what's the general concept? And how long does it take for you on an average to do your research before you say, you know what, we are going in?
I was just checking what chapter 9, chapter 11 were, but I can't remember. It's so long ago.
Yes, of course. That's what all authors tell me. Yes. Yeah.
But I mean, just before we move on, just one thing I should just mention on the unquoted side. One of the reasons that I did it initially was, I think, unless you look at what's happening in the venture space, you don't know what's coming down the line to disrupt you. I'll give you a very good example of that. I was looking at the personnel stocks, Adecco and its peers, and I was quite interested in them at the time. And I then had a proposal came across my desk for a venture capital investment, and it was in personnel space. And I went to meet the founder, who was giving me these amazing statistics about how they'd used AI to comb through the existing databases. And there was a job advertised, I think it was, if I remember correctly, it was a marketing director's role at £120,000. And the AI had found the exact same person that the consultant who was being paid £30,000 had found. And that, that made me feel, oh, that's like really worrying, because it's very difficult to see how margins will be maintained in this industry. Because if you've got that sort of disruptive force, and so I just decided, well, this isn't an area that I want to be invested in. So I think the unquoted space gives you quite a lot of insight into what's happening in the quoted space. But in terms of my quoted investments, I tend to be pretty passive these days. I've got a very full schedule doing the training courses for institutional investors. I'm busy right now building a new course for my online school for the private investors. And so I spend much less time actively managing and actively trading today.
Okay, good. So in terms of your typical entry, like in any of your investments or the research that is taken, I mean, how long would you say? And
well, in the book, I sort of explain the process. So when I was at the hedge funds, typically it would take several weeks to research a position. So, if it was something that was fast moving, or if it was a short, we might start early. So we do so what my process is that I would have a big hopper of stuff that I thought was interesting. And then in order to decide which one of these, where to give priority, I would do an initial review. And that initial review would be maybe 90 minutes, 2 hours sort of thing, where I just went through the basic financials, the business, had a feeling for whether it was going to be a good idea or not. And then the best ideas I would then start to work on. And, often it would take, 6 weeks. And, obviously I'm doing my everyday meetings as well, but that would be 6 weeks of pretty concentrated effort. And at the end of it, I would write a research note and pitch it to the team. And, it would either go in the portfolio, not go in the portfolio, or we might decide to wait for a better opportunity. We would do, those were for long positions. For short positions, in most of my buy side roles, the short positions have been smaller. So we've been able to do less work. So generally, I would do more work in a short position if it went against me. But the short position would be much less work than a long position, because I wouldn't be planning on holding it for a long time.
Ah, I see. Okay, so long would be a much more longer time hold rather than a short. Yeah, short would be much more short term.
I mean, you might carry on holding a short. For example, we might have taken a sort of macro short, because you might have taken a short on a particular macro theme, and you might believe that theme is going to play out for several years, and you might have done that through a basket or through an individual equity or through an ETF or something like that. But if you're doing a stock specific short, you might hold it for a long time if it keeps going down, or if it doesn't keep going down, but you're waiting for that catalyst. But most of the time, what you're trying to do is you're trying to time the short well, because you don't, with a long, if you think about it, you're sitting in a very big hedge fund and you're wanting to build a big position. You've got to be early. And when you're early, you don't know whether you're a month early, 3 months early, or you could be even longer. So what often happens with the longs is you're looking at what the market's going to be thinking about in 12 months' time. So you've bought something, and you're usually buying it as it's still falling, because you can't wait for it to stop falling, because you need it to be falling in order that you can build up the position. As soon as it stops falling, it becomes much more difficult to
offload it. Yes, of course.
Well, no, but it becomes much more difficult to get it on board, because you're buying it and you're putting the price up against yourself. So often what happens is you end up with a position, but it carries on going down. And that's manageable for a long, because you can always carry on buying it. If it's a short and it goes against you, you usually have to cut your position.
All right. Okay. Just on that, as you said, as the market is going down, on a long position, you can buy further. That comes to my second question, which is, have you observed naturally, on position that is falling, do you guys scale into the trades? I know in the book you mentioned about the philosophy of Warren Buffett and Paul Tudor Jones, where Warren Buffett says, if the value is still there, you would keep buying more and more, whereas Paul Tudor Jones says averaging down is for losers. But what would you say that your natural way of investment has been as you've been consulting this institution and for your own self?
Well, the first thing is, once it's fallen a certain way, I always have to do a refresh. So, and that's actually quite tricky, because you've got all this confirmation bias. You've invested 6 weeks in researching the idea, you've bought a load of stock and it's gone down, you're losing money. And if you decide that you should offload it, then, you crystallize the loss and you look an idiot and you've lost money and everybody's unhappy. So it's actually quite difficult to do. But what I try to do is I try to approach it as a fresh position. It's very difficult to leave the baggage behind, because you've got all that. It's not even so much the embarrassment of accepting that you've lost money, but you've invested all this time. So and you've decided that it's a good idea, So unless something has happened in the external environment that means that it's less of a good idea than it was, your natural disposition is to say it's even cheaper. So, what I try to do is I try to understand, why is the market still selling this stock? Have I missed anything? And so I go at it from the presumption that I've made a mistake and that there must be something that the market has seen that I haven't seen. And it's only if I can prove that the market has missed what I've spotted, the reason for being in it, and I haven't missed something on the negative side, that I'll be prepared to average down. But if you're a professional money manager, you've got to accept that your timing isn't going to be perfect. It just can't be. And if you've done your research properly, then you should be confident.
Okay, good. Based on that, Stephen, just a quick one before we go on to the next category, is that what would you say is your best investment to date so far? And what would you say your thinking behind the entry? And of course, feel free to define best in your own way. Best can be the best lesson you learn from it, or the best as in the biggest profit margin you gain for yourself or an institution.
Well, I can tell you that the best investment I made, and I remember it very well because it was a very significant amount of money made. But I'm afraid I'm under very strict non-disclosure rules that I'm not allowed to talk about any of the investments I made when I was at the hedge funds. Every hedge fund has got very stringent non-disclosures, and I just can't talk about them. And in my own personal life, I mean, I've made a few good investments, but you can make good investments just by luck. With COVID, I can remember going into Radio 4 very early on. I think in January, I remember I was in Edinburgh Airport, and Dominic O'Connell, who does the business and markets section at 6:15 in the morning in the Radio 4 Today program in the BBC, and he called me up and he said, "What do you think about this thing with the virus?" And I said, "Well, I think it's going to be very serious." And he said, "Oh, would you like to come on the Monday?" And I was in Edinburgh Airport, so it was in January, and I then went back 6 weeks later to say, "This is much worse than we thought," and then they asked me back another 2 weeks later when the markets had absolutely collapsed, and I said, Dominic, I just bought a bunch of stocks, and he goes, "Well, why? It's the end of the world." And I said, "Well, I've just bought." I said, "It seems it was so difficult to do. I had to hold my nose and buy this stuff, and it just looked too toxic. I could barely bear it. So I knew it was the right thing to do." And one of those stuff, and all of these things were pretty, in my view, pretty safe. I mean, the most risky one was an airline. The second most risky one was an online travel portal. But I bought a UK retailer which had travel exposure, because I just thought, well, people will be traveling again in 12 months or 24 months. And, the stock had fallen by, 70, 80%. And that stock's trebled in a year. And I think if you're just prepared to be patient and take those sorts of opportunities, then you can do very well with those sorts of things. That was just one random recent example, where I'm now looking at that stock and thinking, well, it's actually not that far off where it was before COVID, and people still aren't traveling yet, and so that's one of the ones where I've got it in the portfolio, and I'm thinking, well, I'll stop buying it now, and maybe I should think about when I sell it. And so I'll do some work and decide, what the right valuation is. There's another stock I bought after things had stabilized, actually, where I was looking to put more money into the markets, and I'd taken money out very early, and I was trying to deploy this capital again. And I bought this company which had a lot of asset value, and it had, in my view, had fallen way too far and was trading at a significant discount to the value of its assets. And it doubled in a month. And I was like, okay. But when I've been looking at it, now I've done some work on it, I think that the market's totally undervalued the long-term opportunity in assets. So I'm actually thinking, although it's doubled, I'm thinking about buying more, which sounds a bit, you always feel a bit stupid about doing that. You think, why didn't I buy it before? But actually, often you'll get more comfortable about a stock. And although you kick yourself for not buying more earlier, if it's still a good investment and you think it's got a really good risk reward, and you've got the benefit that you've owned it for a while, so you know it better, because when you own something, you follow it more closely, you understand it better. So I quite like doing that, where it sounds a bit stupid. You buy something £1, and then you buy more of it at £2. But that is that's a lower risk route, in my view, because the more I know about it, the more comfortable I feel about it, the better I'm able to sleep at night. And when I'm making my own investments, it's not just a question of how much money can I make. It's a question of, will I lie awake at night worrying about that? And if I'm going to lie awake at night worrying about it, I kind of don't want it in my portfolio.
Correct. Got it. Yeah, I think you nicely nailed it. And that's what brings us to the next section on risk management, isn't it? I mean, it's very important. I think nicely you say, Stephen. I think the usual saying goes, isn't it? I mean, an amateur investor always asks how much money can he make, whereas a professional always says, how much can he afford to lose? And if you don't get that covered, you can have sleepless nights. Very true. I mean, we've heard a lot of stories on that. So in terms of investments, I know another guy that we interviewed, Joseph Clapham. He was in between trading and investment, and he was talking about using stops and risks management stuff. So would you say you ever use a stop in the market, or would you say you don't use stops at all?
I don't use stops. I mean, I don't have very many positions. So, I'm particularly, when you're a professional analyst looking after other people's money, you are on top of those things all the time. So, there isn't such a thing as a holiday. My wife used to complain when we were on holiday, I'd be at breakfast and I'd be on my BlackBerry. And I said, well, I'm on holiday, but I've still got to check that there isn't anything I've got to do. And it wasn't like somebody was going to phone from the office and say, have you seen, it's expected that you will have seen it and you've looked at it and you'll report it back. So, if I were a shorter term trader doing more things, I might use stops, but it's not something that I've needed to, because I don't have that many positions. Even for my own portfolios, I've got quite concentrated portfolios. And so I don't need to look at everything all the time. And when I was running money, I was running portfolios for a wealth manager for a while. I had very concentrated portfolios, very concentrated. So, if something goes wrong, you know all about it. You don't need to stop.
Okay, got you. And in terms, so it looks like, okay, not putting stops physically or technically into a platform, but then it looks more like a mental stop. If you were to have a mental stop, I mean, would any of these price reductions maybe cause a concern for you? Or maybe let's say if it's a 50% drop or a 70% drop, is that when you will start to refresh and reset and relook at the position again?
No, as I said to you, often we would be early into position and often it would go against us. But, if it falls 20%, you've got to re-examine your position.
20% is the mark when you would start to revisit.
Yeah, well, I mean, you've got to have some
Correct
rules, haven't you?
Correct.
So my rule is if it goes against me by 20%, then I've got to get worried. But, usually before it's got 20%, I'll already done the work. So, by the time it's fallen 20%, I'll usually be in a position to say, buy more or bail out.
Got you. Because, it's a very bit different to, and I think we've had this with a lot of people that we interviewed in terms of Warren Buffett style, where he just holds on to it for the long term, whether it drops, 30%, 40%, 50%, especially with the indexes or some of the stocks that he has invested. What would your comments be on that, Stephen?
Well, Warren Buffett's richer than I am. And, I mean, look, everybody's got their own personal style of investing, and, you can't impose rules on somebody else except in a professional environment. And what I say to my students is, we do this course, the Analyst Academy. It was like a 12-month course, which turns you into, a proper analyst and investor. And part of the program is to develop your own investment philosophy, because everybody's got their own risk tolerances. So, what suits you may not suit me and vice versa. So you might be quite happy owning 100 shares and have stops on all of them so that you automatically get bailed out. If I owned 100 shares, I would go mad because I wouldn't know what any of them were doing. So, your investment philosophy is, how is something going to affect you beyond the financial part? So, do you have enough time and energy and interest to follow more than a certain number of positions?
Mm-hmm.
If you've got a smaller number of positions, will you sleep at night if one of them falls by 20%? And so what I do in the course, I give people some guidelines and questions to help them think about, well, what's the optimum number of positions I should have? And that's a very important part of portfolio management and risk management as well, because the more stocks you've got,
Mm-hmm.
in theory, the lower risk you have, because not a single one can't damage you that much.
Mm-hmm. Mm-hmm.
But actually, the less money you're going to make by definition, because if you got, the 25th idea isn't going to be as good as the 5th idea. And it also is just very difficult to keep on top of them all. So it requires a much greater commitment to master your portfolio, to keep on top of your portfolio. So what I teach are some rules to help you make those sort of trade-offs.
Okay, that's very good. I think it's very nice when you nailed it. It's not the same for everyone, isn't it? You got to find your personality, the time availability, how much you can really handle, and find and bespoke that investment choices according to your personality. I think that's exactly the same principle that we tell our traders as well, rather than just a plug and play where we just force onto trading strategies onto a person. I think very well said over there, Stephen. If I were to ask you, what would be the trait that taught you the biggest lesson? What would it be?
There's so many of them. The one that taught me the biggest lesson is probably error of omission, where you didn't do something you should have done. Been lots of money lost through stupidity, not listening to the market. Probably would be the thing that I hate myself most for. Because you think, when you've lost money, it's part of the game, right? So I don't care how good an investor you are, you're gonna have some bad trades, right? And that's just the nature of the game. So what is the one that you lie awake? I wish I hadn't done that. It's the one that's most annoying. It's not necessarily the one that you lost the most amount of money on, but it's the one where you did something stupid and you really kick yourself. And usually that's where I haven't followed my own rules. Mm-hmm. So I say, well, you're an idiot. You've lost money because you forgot rule number 73. And that's what personally annoys me. So, anything to do with, I didn't pay enough attention to the financial statements. That drives me round the bend. So if I lose money because I missed something in the accounts, because I've just, I've taken a flyer and something, right? And, I was like, oh, that looks a good idea. I think the oil price is going up. I'm going to buy that. And I haven't looked at the balance sheet. And the one I can tell you that I still, I just kick myself at how stupid I was. But a few years ago, I decided to put 1% of my pension portfolio into Nigeria.
Okay.
And it was trading, like 3 times earnings or 4 times earnings. I've forgotten. It was just ridiculously cheap. And I looked at some of the stocks in there, and I thought, this is a crazy situation, because I could easily see that in the next 10 years, this could go up tenfold. And what's the downside, really? Well, the currency could fall through the floor, but there are various mitigating factors. It was just ridiculously cheap. And I just bought this ETF because I didn't know anything about it. So I bought the ETF, and then I looked at my portfolio, and I was down 40% on the trade.
Oh man!
And I went, for goodness sake, how's that possible? And the ETF had a 40% spread. And I hadn't even looked.
Oh.
I just thought, oh, that'll be good long term. I put the position on, and didn't pay any attention. And that really, that's so, and it still annoys me, because it's just like such a basic, stupid error, because you should always check the spread when you're looking at a new instrument. But I just thought, it's an ETF. You know, big can the spread be? And obviously the spread was very big. And so it took me 6 months before it went right. I mean, you know, it's done very well for me now, but you just think, oh, I wouldn't put that on if I'd realized that. And it's those sorts of stupid mistakes where you haven't followed a checklist that annoy me personally. And since I've become, a person who does training, since I started the training business, I'm even more cognizant of that. This was a few years ago. But now I'm like, man, you better not make any of those stupid mistakes. You've got to be truthful to your clients.
Yeah, very good. I think, that's one of the great things about training as well, isn't it? It reinforces in us first before it actually teaches the other person. Yeah, it's nice that you mentioned that because we have that all the time. Stephen, now we move on to more on the exit side of things. Now, I remember this question in terms of the checklist was really good that you mentioned that as well, because it's such a simple thing, the spread. But sometimes we just in the swing of things, we forget the simple basic things and we make errors that we regret for. So that's why a checklist is really good. I really like this question that you put in the book where you have mentioned Jeff Bezos. He usually asks the question of what will not change in years to come, as opposed to what will change when choosing the company that you want to invest. So based on that, would you say that's a question that you would usually ask, especially when you are researching a company, looking at the macro side of it and the exit side of it as well? Or if that's not the question, what other similar questions would you ask in terms of determining an exit?
Well, I mean, I think the way I look at it isn't in terms of, what will not change. I mean, I think it's an important thing to think about. But, what I tend to look at is a distribution of outcomes. Mm-hmm. So I then say, okay, here's my central case. But what happens, usually when I come to a stock, I'm coming there for a particular reason, right? Something has driven me there because either I've seen something happening that I don't think the market is fully valued, or I think that the market's got the wrong idea about something. Usually, it'll be like the situation I was mentioning earlier, but in the middle of COVID, I thought travel would get back to normal eventually. So I say, okay, so that's my central case. And then you say, okay, well, what other things could happen? And, I said, well, we could get a vaccine very quickly and we could get back to normal very quickly. And that was my central assumption because I just thought that, the world's brains directed at a single problem are going to solve it quite quickly. In actual fact, I've been slightly bemused at how long it's taken to get, we got the vaccine, the shares have gone up through the roof, but actually it's taking a hell of a long time to get on holiday. Goodness knows what's going to happen this summer. But I'll tend to look at it in a range of outcomes. So, my central case in that case was travel will get back to normal by the summer of 2021. Worst case, summer of 2022. Now, that probably wasn't the majority view, which gave me the opportunity because the consensus wasn't thinking that. So there were stocks that were misvalued if that's your central case. But you've then also got to say, well, I've got no knowledge of vaccines. This is a complete punt on my part. So what happens if I'm wrong? And then you've got to say, okay, well, if I'm wrong, Ryanair may not be flying again until 2024. Have they got enough money? I mean, so then the first question is, have they got enough money to last till 2024?
Very good. Yes.
And does that take away my case for the stock? And in fact, it doesn't, because they've got enough cash that they'll be able to sit there and they'll still be around in 2024. And all the competitors, bar one or two, will have gone bust. So they'll have the field to themselves for quite a while. Obviously, the planes will come back into circulation and new airlines will start up and the planes aren't going to sit on the tarmac forever. But they'll have a window in which they can get even more market share and they can drive prices up. So even if I'm wrong and I'm over optimistic in my central case, The bear case is actually more bullish for this stock. Right? So and then what's the upside case? So upside case is we discover a cure for the vaccine, and it's a tablet, and they can manufacture it, and instantly the vaccine disappears, the virus disappears, and everybody's going back to traveling tomorrow. So that means that the smaller players don't. But that's good for my case. So those are that's the sort of situation I like to look at. And so I'm looking at my central argument, but I'm looking at both the bear case and the bull case, and asking myself, have I got protection in across the board? And that's the sort of situation I look for.
Interesting, because I know you dedicated a section on this when things go wrong, and that was what you just explained over there when you consider to enter and to exit. Just a very quick question on this, Stephen, is that when you enter into a stock price, let's say you bought it at $1 or $2, I mean, usually do you have like a projected price that you would like to exit on? Let's say 5 times it, 3 times it. Would you have that in mind usually?
Yeah, I usually do. I mean, I have 2 slightly different strategies. Mm-hmm. So as a professional investor at a hedge fund, you're trying to deploy capital in such a way as to maximize the returns at all times. And therefore, you don't want to buy something and hold it forever. I mean, you're charging 2 and 20. You're not getting paid to do that. You're getting paid to turn over the portfolio and get the maximum out of both the long and short sides of the balance sheet. And so, buying Nestle and holding it for 20 years might be more suitable for a long-only fund with a high-quality bias, and that's fine. But you don't get paid 2 and 20 to do that. People want you to find more esoteric instruments, more esoteric investments. So you tend to be looking to turn them over. Having said that, I mean, I'm not short-term at all. I'm there for the long term. Mm-hmm. But typically, I would look to hold something for 18, 24, or maybe 30 months. It'd be very unusual for me to hold something for 5 years. Possible. I mean, it would happen. But most of the time, you say, I'm buying this at, $20 because I think in 2 years' time, it's going to be 40. And you might be right or wrong in the 40. It might take 6 months to get to 40, or it might take 3 years to get to 40. You don't know. Timing
is always tough. Yes.
Yeah, you can't predict that. But you've got, usually I would have a pretty good idea that this company was going to generate higher profits than the market had assumed. It was going to do that in a quicker timescale than the market had assumed. Mm-hmm. And therefore, the stock would get re-rated and go up quite significantly. And I would have a measure of that. But that's not to say, so I might buy it at 20 and thinking I'm going to be out of this in 40 and 18 months. In 18 months' time, it might be 40. And I might think, oh, it's going to be 80 if I hold it for, So you just look at it again and say, well, is it all in the price, or is there still more to go for? And what you often find is that you buy it at 20 with the idea you'll get out at 40, but you actually get out at 60 because when things go well, they tend to go very well. And then the stock market gets over enthusiastic. And the most annoying mistake is when you sell it too soon. Mm-hmm. You think, oh, I've done really well, and you leave 100% on the table for the next guy. You think I made 3 times the money, I'm a genius, and you could have made 6 times if you'd only waited.
It's interesting you say that. In trading, we usually get that as well. But what I would like to ask you is, okay, on one aspect, you exit early and you can say, okay, yes, I could have made more. But on the other hand, if the price comes against you, let's say you wanted to sell at 40, but then you thought, okay, it's going to go to 80, but then it comes back all the way down to 25. Then at that time, then you would think otherwise as well, right? That you could have sold it at 40, isn't it?
Yeah, but I mean, I would, if it went from 20 to 40 and then started to fall, I would ask myself, well, why is it falling? And I'd re-examine it. I mean, obviously, I might say, oh, it's worth 80 and, it's got to 25 and, I would say, oh dear, what am I going to do now? And, I might well sell it at 25, often I've done, I said, well, I really think this is going to happen. I really think this has got this value, but the stock market just is ignoring it. And so sometimes I'll just give up, I'll just say, okay, and usually when you give up, the next day people go, oh, that the market punishes you, but everybody has exactly the same thing. I mean, I remember having lunch with a very famous, one of the largest hedge funds in London, the founder, and he'd bailed out of this stock because he just got fed up waiting. He said, I'm sure I don't understand it, but I've owned it for 2 years, it's gone nowhere, and I may as well just put this capital to work somewhere else. And that stock, from the point that we had launched, has gone up 4 or 5-fold.
Oh man, okay, that's
and and he had, he didn't have $100 million in it. He had a big position, and that it does happen. You get fed up, and that's why Buffett has done so well, because he's got more patience than
anyone else. Yes, you're right. Yeah, he just holds on. I mean, his assessment has always been, is there still value in that stock? And if it still has, he doesn't care how much it reduces. He will just keep holding on to it. But you were saying that most hedge funds, they are not in line with that idea. Is that right to say?
Well, I mean, I don't say most. I mean, certainly there's a perception amongst hedge fund investors that they're paying 2 and 20 for a very specific set of skills. And owning the same stocks for 10 years. I mean, don't get me wrong, I don't think anybody would sell out of a successful hedge fund because it owned the same stocks for 10 years and if they were doing very well. And obviously we've had a very unusual 10 years in the last 10 years. So if you'd owned Amazon or any of those stocks for the last 10 years, everybody would be very happy. But they don't really pay you to own Amazon.
Correct.
Because they own Amazon themselves. That's the kind of that's the assumption from many of the end customers, the real money investors. So often, I mean, not all of them, but often the big fund of funds, the big pension fund investors, they're expecting you to do something different with their money than if they're paying 1% to a long-only investor. And yeah, I mean, part of that is shorting, but I think there's also an expectation that they'll see some idiosyncratic ideas where you're generating alpha in ways that other managers couldn't. And so you're kind of pushed to buy things that aren't as fashionable or as popular. Not to say that there's, David Einhorn's biggest position was in Apple. It's fine to own it when it's very cheap, but you wouldn't have all your portfolio in there. And,
correct.
If you looked at his portfolio, yeah, the biggest position was Apple, and he had a big position in General Motors, but he had, things like Kimura's, which nobody had heard of because it was a spin-off, and, it quadrupled, I think, with that one. So you've got to justify your fees.
Correct. You know what? Just a thought that I had. I mean, I would have thought if Apple and Amazon, I mean, even though they were 20% of the portfolio, the usual saying goes that 20% makes 80% of your profits in most portfolios. Then I would have thought, probably you got the experience to give your views on this. I would have thought that hedge funds would then recruit and hire analysts and professional analysts like yourself to find more of those stocks which, when held over 20 years, will give 80% of the profits. Would it not be the right thing to do then?
Well, I think it's very difficult to hold a stock for 20 years.
Okay.
I mean, first of all, every hedge fund is domiciled offshore. So most of them are domiciled in the Cayman Islands. So you're not paying any capital gains tax. No tax considerations. You can buy or sell. The only frictional cost is the spread. And there's inevitably in a 20-year period, there'll be periods in which the stock goes sideways for 2 years. So, you're not paid to sit with dead money. So you're paid to maximize the returns. I mean, I'm not saying that you couldn't own a stock or 2 stocks or 3 stocks in the portfolio that you own for 20 years. I'm just saying, if you had a portfolio like Terry Smith's, where he proudly reports, we made 1 sale this year and 1 buy. I mean, he's done incredibly well, and there's no question he's an investment genius, and he's happened upon a set of criteria which have been incredibly effective in the last decade. And I've got a huge amount of admiration for him. But if he were running a hedge fund, I'm not sure that people would be prepared to pay the premium fees.
Got you.
That would be my
Makes sense. Yeah, I think when it comes onto the ground, then other things start to come into play. Just a very quick question on exits, Stephen. Just a very quick one from you, answer. Would you say when you exit most of your trades, personally or for hedge funds, when you had advised them, would you say you feel at peace when you exited most of your trades?
It depends what happens to the share price.
Okay, so it's dependent on what happens afterwards.
Well, sometimes you sell it and it carries on going up, and you think, oh, I'm an idiot because I could have made that extra. But I tend to be early in, early out. That's my weakness as an investor is that I'm not patient enough.
When we asked this question, I think to different people, in fact, we got this question from the New Market Visits that Jack Schwager went to interview the other millionaire traders. I mean, some of them do say that, at the end, whatever happens afterwards, they've just come to negate it because they feel that they've done whatever that they can to their best with the principle that has worked for them for all these years. So that's why, everybody answers that question very differently. But yet again, no matter how people say that they feel at peace, I would still say after you exit, if you still see it going 10 times, I guess, yes, there might be still a little bit of regret or thinking.
Well, it's partly regret, but it's also partly learning, isn't it?
Yes, true.
If you don't look at what happens to the share price afterwards, then you don't know if you've made a mistake or not, and then you'll make the same mistake next time. So, I know that I tend to sell too early. So I know that when I first want to sell, I should wait. I wouldn't know that unless I'd seen, that was my pattern. And so I do think it's important to understand your weaknesses as an investor and your strengths if you've got any. But, it's important to understand if you have a tendency to sell too early, you can leave a lot of money on the table. And that's a crime as far as I'm concerned, because the difficult thing is doing all the work to find the stock idea. And what slightly amazes me, we're doing a course on behavioral finance, which will launch in October, which is a cohort-based course where we actually tutor people through the process. And, one of the things I find astonishing is that investors don't spend time trying to improve their process. If you can improve your process by just 1%, rather than going to find the next 5-bagger, you can just look at what you do and what you do badly and try and just improve that little bit. Well, every year that will pay you a return. The next big thing will be the next big thing for a year or two, and then you need to find another next big thing. But if you can improve your process, correct, that's a gift that keeps on giving. And that's why we're doing this new course, because I think that's the way we can make the biggest difference to people's performance.
Very nicely put there, because it just reminds me of 2 things that comes to my mind. One was what you just said. If you can just think about what you learn from it, what you can improve, that will actually make your identification process much more better and your returns much more better. Based on that, Brian Tracy talks about, which is what is called slow thinking. There's 2 types of thinking. One is fast thinking, one is slow thinking. Slow thinking is what you just described in terms of taking yourself out and contemplating and refining your process. But unfortunately, most of the human population, we get triggered into momentum and want to keep doing and doing. rather than pulling ourselves back and thinking about what we can actually do better. In fact, then he also gives 3 questions what you can always ask at the end of each day or end of each month or end of each year, which is what went well, what did not go well, and what can I do to improve, which is exactly what you're just saying. But yeah, it's just about reminding ourselves. Just a touch question, the last few questions before we end. I'm just aware of time as well. Ray Dalio talks a lot about, he does mention that as a pre-trading routine or a pre-investment routine, before he looks into the markets, he has got a meditation that he does, and he explains why that's important, because to balance the left and the right cerebral hemisphere. Furthering on from what you also spoke about behavioral finance as well, would you say that you yourself, do you employ any kind of pre-trading routine, let it be exercise, meditation, or breathing exercise or mindfulness into your routine?
No.
All right, none of that.
I do yoga,
Okay.
but I don't do it with a view to improving my investment performance. Full of admiration for people that meditate and do these sorts of things. I mean, I think the one thing that I do say is, if you're very tired, be very careful about making decisions. So, I used to travel a lot when I was a hedge fund analyst, doing global research. So, trying to make a decision when you've just flown in from somewhere, very bad idea. Leave things till the next day. And that's the only kind of thing like that. So, we would never try and trade, the stocks released results. We would always want to listen to what the company said, always want to try and spend some time analyzing the numbers before we decided to sell our position, because you want to make sure that you're doing it on the basis of complete information. But maybe I would have been more successful if I'd meditated.
I mean, Ray Dalio is bent on that, isn't it? He just says that it improves the creative process and also idea generation as well. But anyway, I mean, I guess everybody is going to be different. Just your last viewpoints or your opinions on the 3 sectors that is coming up. I know you touched a bit on the book as well, in terms of, would you like to say anything on the sectors which are evolving and emerging, like artificial intelligence, robotics, or blockchain?
Well, I think they're all worthy of study. I think artificial intelligence has been so overcooked in terms of people talking about it. Almost every single earnings call, whatever the subject, whatever the company, they're talking about artificial intelligence, and most of it's not most of it, a large part of it's pretty nonsensical. The thing that I think is very interesting at the moment is blockchain, and how how blockchain can be used to reward users. But I'm not sure that it has a huge amount of impact on the quoted equity investment space. But I think we're in an era of disruption. So in the same way that I say you've got to do some venture capital to keep on top of what's coming down the track, you've got to keep on top of these subjects. Otherwise, if you don't understand them, they'll come back to bite you. And in fact, I don't know enough about cryptocurrency and blockchain, and so I'm doing a research project on it at the moment. But not with a view to buying Bitcoin or anything like that, but just because I want to understand it a bit better. I think I've got a pretty reasonable understanding of AI and how it can be used, and I'm not shaking in my boots at AI taking over the job of the forensic accountant just yet.
Okay, are there any stocks that you would tell people to keep an eye on in any of these sectors, or is it something that they would have to research on and do their own thinking on?
I actually gave up my FCA registration because I just couldn't. I thought if I fill out another one of these quarterly forms, I'll have to go and jump off the building. But the FCA is a client of mine. I've got, a number of regulators are clients, and although I'm not FCA registered, I just feel that I should behave as if I were, and that means not giving public recommendations. If you follow my blog at behindthebalancesheet.com, if you sign up there, we've got a club site where I will post some odd thoughts. I'm actually just writing something just now about Carnival cruises, where, you look at it and you think, well, why is Carnival valued more highly today than it was pre-COVID? And, I just don't see, that. I haven't done any detailed work on Carnival. I don't know anything about it. But just when I look at that, I think that's very optimistic. And in order for that to be proved right, prices of cruises would have to go up quite a bit. Now, it may well be that they do go up, because it may well be that everybody's so desperate to go on holiday, But, I tend not to make individual stock recommendations. And that's not a stock recommendation, just an observation that there are quite a few anomalies in the stock market just now. I think it's quite a tricky market.
All right, thanks a lot for this, Stephen. Just a quick one, just to wrap up for the audience, and also for anyone listening on the YouTube videos as well, the recordings and everything. So you mentioned a little bit about your 12-month course, and you also mentioned a little bit about your blogs. So where would you say is a really good place for people to find out more about you and what you do?
Yeah, sure. Thank you for the opportunity. So, and thank you for having me. You can find me on Twitter at Steve Clapham, Clapham. My website is behindthebalancesheet.com. My book, The Smart Money Method, would be for sale at all good booksellers if the booksellers have got their stocks in, but you can get it on Amazon or from my lovely publisher, Harriman House. And the website, behindthebalancesheet.com, if you sign up there, we have what we call a club site where we post all sorts of free training and useful materials. And finally, I've got a YouTube channel, and the YouTube channel is Behind the Balance Sheet. And we've got, I don't know how many, tens of videos talking about, how to improve your investing, how to spot accounting red flags, and how to value companies. It's a really good resource. Lots of people have been very enthusiastic about it. Please sign up, subscribe. I'm on a race with my 12-year-old son, who has bet me that his little pal, who's got a Minecraft channel, is going to have more subscribers by the end of the year than I will have. Please help me win that.
That's a really good challenge for everyone over here, right? So I've just put into the chat box on how you guys can get the Smart Money book by Stephen. I've put the link over there. There's also a discount code that Harriman has given us for all MTM members, TT30. I've put that into the chat box as well. And also we will be sending out an email for those of you guys who missed this interview. You can watch the recording and can also purchase the book. And also we'll put the link where you can get to find out more about Stephen. I will just show this. Stephen, is this the one you're talking about, Behind the Balance Sheet? Is that right?
That's it. That's the one.
Correct. Yeah. So
if you click that sign up on the top right, you get
that one over there.
To the club site.
Okay, sign up with an email, right? I guess that's the one over there. Okay, so you guys can have a go at that. And the other thing is the book, of course. The book is over here. I've given you all the link, and you can purchase that. I would highly, highly recommend the book. And I've read it myself. I've enjoyed it thoroughly myself. For any professional investor, let it be institutional or private, definitely an absolute must read, I would say. All right, Stephen, I really enjoyed the interview here. Thanks for your time. Thanks for sharing all this information with us. And we look forward to connecting more with you. Any last words that you would like to say?
No, just thank you for having me. And, for your viewers and listeners, please do buy the book and sign up on the website. And make sure you check out the courses, because I think it's a very new concept to be able to do an investing course which has been created by a serious practitioner. It isn't available anywhere else. And people are very unfamiliar with this concept. But I can tell you, the people that are doing my Analyst Academy course love it. And it's really, really helpful. If you want to improve your investing, invest in yourself, because that's an investment that will pay you dividends for many, many years to come.
Brilliant, Stephen. That just reminds me, we need to continue also. Yeah, I will talk about how we can also further this, what you've just done for the investment world with every trader that comes through our program as well. We can always talk about that further on, because we really want to support this. And we know that, it's very important that people should learn about this. And if you've done this amazing course, which is just segmented, just beautifully like the book, that is something that the world should know about. So we'll be happy to support that mission forward.
Thank
All
you
right.
so much.
All right. Thank you, everyone. Thanks for listening in. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Thank you, Stephen. Thank you, everyone. Bye.